But I digress. Brian, how are you? Good to see you.
Good morning, George. Doing well.
Excellent. Where are you? You're out in the west somewhere?
I'm in Denver.
Denver. Cool. You got snow?
No, we've had very little snow this year. It's actually the lowest snowpack since they've been keeping records. And here in Denver, it's going to be 68 today.
Got your shorts out.
Uh, yeah, I'm actually sitting in boxers.
That's the good thing about doing these spaces. You can sit there in your boxers, picking your nose, doing whatever. No one knows. That's the thing. I have this love hate relationship with this app. I hate X, but I really like the spaces. Otherwise, I'm migrating my stuff to Substack and elsewhere. But at any rate, so there's a lot we can talk about. I'm just going to hit on a couple things before we get into it because I came here to hear you, Brian. There's so much daily volatility one day to the next, and people keep chasing the shiny object, especially all the talking heads, where that's not what's important. Anyone who's focusing on day to day is just missing the bigger picture. It's very clear to me, and I could be wrong, but it's very clear to me what's going on in the bigger scheme of things. We talked about this in this space a few times now. We had Marianne Bartels in last week, and I can't remember who was in the weeks before, but R is for rotation. And as Dennis Gartman used to say, do more of what's working and less of what's not working. You don't have to have a market view. I find hysterical the funerals that some of the tech bro are having. They're in their own little private bear market, as Stan Weinstein would say, or not so private actually. And then they get mad because the indices are like within 1 or 2% of their highs. Then you have things like energy and some value stocks and staples and everything breaking out to new highs. It's a market of stocks. It's always important to look under the surface to see what's going on. Just as the last few years, if you didn't own Mag Seven, you were nowhere in the main scheme, in the bigger picture scheme of things, because they sucked all the air out of the room. The 493 did nothing. The seven was leadership. Well, now it's reversed. So first shall be last, and last shall be first. So I think we're witnessing the death of speculation. The most liquidity sensitive assets are getting hit the hardest. Crypto, meme stocks, some of the really high PE stocks, software stocks. And the great Michael Howe, who we've had in this room numerous times, is sounding the alarm on the coming ominous conditions for liquidity. I put something in my Substack about this a couple of weeks ago. I actually put one of Michael's reports in. And so, Brian, before we turn to you, I just want to make one announcement. Well, two announcements actually. So, one, you guys all know that I'm having this conference on March 11, 15. Fantastic stock pickers showing up. Again, it's not what I have to say; it's what they have to say. Imagine, you're putting on a concert and you get to pick the best musicians in the world. Well, that's what this is. 10 of the speakers we had on last July. It was terrific. You're going to get 15 speakers for just $99. Um, a lot of alpha. And I don't know where you're going to get that type of intellectual capital for such a price. Another thing I wanted to say is I did launch last night my paywall on my Substack. It's been free since I started writing about 6 weeks ago. People have really liked the content. Happily, I've been right on pretty much most of the things I've written on. Whether it's individual stock ideas like, being long Southwest Airlines, short Tesla. I've called out a lot of shorts the last few months. And, Oklo and the quantum computing stocks and so on and so forth. I've been big on energy. Valaris, I got very lucky. I tipped that as a long in mid-December. The videos on my feed at 54. They got taken out. I think the stock's 84 or 86 right now. So that was like within 6 weeks. So I've got a lot of ideas, and I'm happy to do these spaces. But if you want the best of what I got, you're going to have to pay for it. It's you get what you pay for. You also don't get what you don't get paid for. And I've done these spaces for no personal gain over the years. I'm increasingly doing more content on YouTube, and my best stuff is going to be on Substack behind the paywall. Individual stock ideas, a portfolio monthly. You can do what you want. I had a bad run in with the ETF a couple of years ago. Haters going to hate, and they're all going to say, "Oh, Noble's now shilling his stupid Substack." Okay, gotcha. But that was a debacle, that ETF. And if people want to ask questions about it, I'm happy to talk about it. I've talked about it before. I got nothing to hide. Last time I checked, there was no law against making an investment mistake, but there are laws against securities fraud and lying, which a lot of furus do. But at any rate, individual stock ideas, a portfolio, curated, paywalled research. Michael Howe, Louis Gav, John Roque. It's the kind of stuff you don't have access to as an individual investor. It would cost you, I don't know, 25, 30, $40,000 to get this stuff. So every week, every few days, I'm going to put out something from one of these guys who are friends of mine, have been subscribers for years. That's an incredible value. Also, we're going to have recordings of the podcasts and the spaces. You will no longer be able to access recordings of spaces on X. I'm not going to allow that. You're going to have to go to Substack to get them. You can hear it for free, but you'll have the recordings. It's a much better experience listening to the recordings on Substack. There's also a summary, not a transcript. I hate transcripts, but a curated summary, AI assisted, of what the salient points for each episode. I think we have a no-fly zone, stocks that went short. There's a whole bunch of stuff. There's like 7 different features that you're not getting in my free Substack right now. It's $45 a month, 540 for 12 months instead of 450. And if you act now, boy, I feel like I'm shilling relentlessly, but I am. I'm actually trying to help people. Yeah, I'm gonna make a few dollars in the process. No one has to buy this thing. So just for all the haters out there, I'm just gonna tell you right now, you're gonna get blocked immediately. So get off my front lawn. I think this my conferences are terrific because I got the best speakers of anyone. I think my Substack is going to be the best of anyone's Substack because again, it's the content, a lot of which is coming from other folks. So anyway, $45 a month. That'd be 540 for the annual. It's going to be 450. And if you act now, I will throw in the conference for free. It's $100 value. So one year subscription and the conference all for 450. All right, enough. I feel like a used car salesman. I feel dirty having said that, but if you don't promote, you don't market, you don't sell. So there you go. All right, Brian, a lot of moving parts. The market's all over the place. You know, the talking heads on CNBC and elsewhere, they're screaming about something every day. I think we've got a huge rotation going on here. I know, you're pretty quick on your feet. You don't die on hills. You trade what you see, not what you think. And so you've got a pretty good nose for keeping people out of trouble. So, Brian, I'm going to turn the floor over to you. Go wherever you want with it. Talk as long as you want. What's top of mind for you? What are your convictions? And most importantly, it's, how do we help folks in the room make money? What should they do with their portfolio? So, Brian, good to see you. The floor is yours.
Yeah, thanks, George. That's my whole focus is helping people make money. I've actually my stated goals are to help people make money, help them avoid losing money, educate them, and to provide a positive environment. And like you said, X isn't always the best place for that. It seems to be kind of, tends to be the loudmouths are the negative people. They get the attention, but there's a lot of good people and good information on Twitter. So, I look at it and like you, George, I'm interested in separating the noise, what's good information to help make money versus all the noise out there. And that's my focus every single day. There's a lot of interesting, so I have a Discord. And in my Discord, I've got a channel called Interesting but Not Useful. So I've got, my focus there is let's make money. But some people can't help themselves. They need to, go and talk about, hey, did you see this stock or that stock? And, that's interesting. But if a stock has already moved and the opportunity isn't there, it's just noise. So I look at it and say, what is helpful and where can we make money? Where's the money flowing? What's looking interesting? This week on Monday, I looked at the utilities because they popped up, beyond a little bit of resistance and an anchor off of the October high. And I figured maybe they would pull back a little bit on Tuesday, then I get an opportunity to get involved. I got involved for a day trade, but man, I didn't expect these utility stocks to go 7% this week. I don't know if you saw Friday, they were up 2.75% on the utility index. So, everyone's obsessed with, like you said, the tech stocks that are breaking down and having a lot of trouble. And, the fact that Bitcoin has been having a lot of difficulty. But, there are places out there to make money. The energies, I'm sorry, yeah, energy names have been on fire. Now the utilities. So things are not as bad as people always say. Even, I look at it and I hear people talking, same thing, George, we started out, the snowpack in Denver. We've got, bad snow conditions in the mountains, but I've been up there a bunch of times and I've had great snow. And, I hear people do nothing but complain about the snow, but if you've been up there and you know where to go and find the good snow, the opportunity is for fun is still there in the mountains, just like the opportunity to make money in the market. There are places, and you don't have to be bearish and shorting things. There's a place for that as well, and the bears have certainly been right on crypto and a lot of other a lot of the big tech names. So it's just about separating the noise and saying, "What's important? How do we use this information to make money?" And do so recognizing we're gonna be wrong from time to time, and risk management. I'll always fall back on risk management. I can make a call and, some people will come back to me, some little twerp on Twitter will say, "Ha, ha, ha, you called this and you called that, and look at it now." I'm like, "Well, 1, you know, I got stopped out with a 2% loss. What's the big
Yeah,
deal?" Like,
and Brian, I got to interrupt you for a second. Yeah, not only do you do that, because like by definition, we're in a business. If you're only wrong 40% of the time, you're doing a great job. Just like in baseball, if you only make an out 70% of the time, you're doing a great job. And so you want to play gotcha? That's the way they roll. And the other thing I really like is you'll make a call, it'll work. Say you say buy gold, so it goes from 2,000 to 3,000. And so you're taking profits or whatever it is. Or you don't take profits, it keeps going up. And it goes from 5,000 down to 4,500 and they come after you. I mean, I call them the illiterati, the financial illiterati.
I like it.
These are the guys who were summa cum laude graduates of the Dunning-Kruger School of Finance. They mostly tend to be on the younger side. I don't want to pick on youth, but I'll say it another way. They tend to be folks who've only been involved in markets for the most part, post COVID. The extent of this garbage, these types of ill-informed bad takes, is inversely proportional to time spent in the market. And these guys are going to get an education. They are getting an education. I think it's hilarious. They're going to be blown up in their favorite meme stock. Crypto's going down every day. You and I, Brian, you're old enough to remember when, Dennis Gartman, please call your office. In a bear market, you're only either you're flat or short, flat or short. Don't trade counter trend. Bull market, long or short, long or short. Don't trade counter trend. They know nothing, but they're certain of everything. I despise these people with their baseball caps, and they can't read a can't do any financial analysis. Okay, and they're making complete fools of themselves. I'm in a big dust up right now. I'm sorry, Brian, but you triggered me on this
Sure.
POS open door. I'm sure you're familiar with ticker symbol
Yeah.
open. All right. There's this shyster, and he won't come in the room. If anyone knows Eric Jackson or Anthony Pompliano or Keith Raboy, have them come in the room right now. I'll be respectful, but they won't because they've been dishonest. They've lied. They promoted things. They belong in jail. And, so Jackson pumps this thing. He goes after the biggest garbage he can find, guilty of analytical malpractice on steroids. Stock rips from 50 cents to $10. I only first found out about it in a space in early September and 7 and change. I have put hundreds of posts on Opendoor. I had a fixation on this stock. I mean, it was not good for my health. I was interviewed. It was a post from Eric, not Eric, what's his name? Stern. In the fall, I was labeled the biggest bear on Opendoor, blah, 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 blah. The vitriol, the hatred, the 4-letter words. Brian, that's the type of thing which happens only when you have a losing arm, which, by the way, I'm going to stop right here. And Brian, I'm going to embarrass you, but I'm going to praise you.
Here we go.
Here we go. But Brian, this has a happy ending, as they say. You know where this is going. Boys and girls, ladies and gentlemen, social media is the bane of our existence. I hate electronic communications, texting, email, no substitute for picking up the phone or, God forbid, seeing someone in person. Because the problem is all our remarks are missing context. So a few months back, I guess Brian was having a bad hair day. He led, and Brian and I met a few years ago at the CMT conference. So I don't even remember what the tweet was. Maybe you do. It's not important. You're entitled to your own opinion. But you're not entitled to your own facts. Anyway, Brian takes a shot at me, and I was like, whoa. I don't even remember what it was, and it's not important. I was like, whoa. So instead of taking a shot back, I'm like, well, I know Brian to be a solid citizen, so I'm just going to kind of like hang here and see where this goes. And Brian, this is so out of character. I'm here to praise Brian, to embarrass him, but to praise him because this proves the point about it's not what happens, it's how do you react to what happens. Okay. So Brian takes a shot at me. I don't flinch. I could have said F you and all that sort of stuff, but I didn't. So I gave him the space to reflect on what he said. And he comes back to me and goes, right, he goes, oh, I'm really sorry. I shouldn't have said that, blah, blah, blah. I don't think it was that day. I think it was like a day or two later. Whatever, it doesn't matter. And come to find out, Brian had a serious situation with his dog. So, hey, I love dogs. If I had a bad situation with one of my dogs, I'd be having a bad hair day. I may not be in the best mood. But the key point is, okay, Brian made a mistake. We all make mistakes. We all have done what Brian did. But then you may say, out of character, I didn't respond. I was like, okay. And Brian comes back and says, gee, I'm really sorry. I had this bad incident, yada, yada, yada. I'm like, okay, we're all good. So we're good. And here we are a few months later. Brian's in one of my spaces. As opposed to these assholes, and I'm going to call them assholes. They mostly tend to be crypto people and young investors. Their bedside manager is atrocious. They don't cut anybody slack. I'm not a religious person really, but there's something to be said for giving someone the benefit of the doubt. Tina and I are friends. We've yelled and screamed at each other like brothers from time to time. It's all in good in good faith. But the rudeness and the uneducation, the vulgarity, the barbarians at the gate on this space, and it's exacerbated by the anonymity. I actually think Twitter, if we're gonna have spaces or whatever, spaces, maybe they should force everyone to put their real name up on here. I mean, it's just people do stuff anonymously they would never do in person. So, Brian, I just throw a lot. So, I thank you. I think that was a teaching moment. Not what I'm saying here, but both you and I. It was an experience. I'll tell one other story, third person, similar to this, which will give a flavor. I was at a conference a few months ago, and I'm gonna keep names out of this. I don't want to embarrass the poor guy. I was at a conference, and a professor, one of the leading experts in the constitutional law in the United States, got up and made a presentation. And at the time, this was in the wake of the Trump administration announcing a tax on endowments, more specifically, a tax on the income of endowments. And I was at something at an Ivy League. It was at Yale, actually. I was at this presentation, and he made a mistake. He got up and he said they're going to have a 21% tax. I think that's the right number. 21% tax on the assets of endowments. And he's like, 21% tax in 5 years. The whole endowment's gone. No, it was a mistake. It was 21% on the income of the endowments. And what happened was he said it with such authority. Everyone in the room thought he was telling the truth. And I kind of fell out of my chair. I'm like, that can't be right. It's on the income, it's not on the assets. But he said it with such authority. I started to guess myself. So I quickly go online, do a Google search. Of course, it's 20% of the income, not 20% of the assets. So rather than raising my hand and playing gotcha with the guy in the room, I waited till it was over. I go up on the quiet on the side and I introduced myself. He didn't know me. And I was like, it's sufficiently deferential. It's not like, you idiot. I mean, this guy's, he's an expert in constitutional law. What do I know? And I kind of do my Columbo thing, like, hey, gee, I showed him, I told him my understanding, and I handed him my iPhone. He goes, where'd you get this? It is a primary source. I said, yeah, I showed it to him. He looks at it, he froze. He goes, oh my God. He goes, if what you're saying is correct, if this is right, then that's just terrible. I have to correct myself. Now, this professor was about to go make a presentation in another lecture hall 10 minutes later. He was probably going to say the same thing. I could have called him out and busted his balls in a room full of 200 people, but I didn't do that. I went on the quiet and I said, sir, and I showed it to him. You want to know something? Later that afternoon, I get home. He calls me. I'm at home having dinner. I just want to thank you. Yada yada yada. He goes, "Can I call you my friend?" Yeah, I'm your friend. So I'm good friends with this guy. So, Brian, yours is not a unique experience. So I'm going to stop. So, Brian, I don't know what you want to add to that, your perspective, or explain exactly what had happened. You had something with one of your dogs. Is that right, Brian?
I did, and that dog went on to pass a couple months later. But it was really like I said, George. You said something, and I said I responded with nope, the symbol of your ETF, and
Right,
that was and you said thanks for your kind words. Never made a mistake yourself. I said, George, that was fair of me. Sorry, you caught me in the
right,
mood.
right.
And then I reflected a little bit further, and I'm looking at the message, and I said, "George, if someone responded to me the way that I did to you this morning, I would think and block them."
Yep.
My response was a bad moment, not who I am, sincere
Sure.
apology. So, yeah, I mean, I think I'm like you, I'm quick to block people. And it makes me like you said, people on Twitter, they hide behind an anonymous face, and it's kind of similar to what's going on in the news in Denver, that they're trying to pass an ordinance that ICE officers can't have a mask covering their face.
Right.
Fair enough, but you know what? Why not why not expand that and say, "Let's not let the protesters wear a mask as well.
Bingo.
Let them come out and show their face."
Bingo.
Th and no one's calling for that
Oh,
legislation. Like, let's
and,
keep it fair and open and honest.
and Brian, to your point, which I'm involved with, even though I hate all the stuff that they do, I did go to that school in New Haven. Um, there've been problems on all these campuses, particularly with some of the anti-Israel protests. They're anti-Semitic protests, but I digress.
Mhm.
But let's say you don't have to go there. That people are protesting and doing crap with masks on, it just should not be allowed. And to your point, and you bring this up, they scream Islamophobia and blah 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 blah. So then I said, okay, fine. You know what? You want to keep your mask on? Okay, there are other ways we can do this. Why doesn't everyone wear? If you're going to be I mean, listen. If the protest is occurring, and I don't want to get into political discussions, but I am going to go into this rabbit hole for 5 seconds. If it's occurring on public property like a street, Yale can't do anything. But if it's on the Yale campus, they can do whatever they want. And so if people, I mean, Yale University can do whatever it wants. So if Yale is not going to enforce or promulgate a policy where you have to show your face, they could certainly, as a solution, a second best, insist that everyone has to have a name tag on, but they don't. And it's exactly what you're saying. So they just, Brian, you know what it gets? There's just no accountability. There's no, everyone's trying to game the system. They always do, but it's worse than it's ever been. But anyway, let's get
Yeah.
back to markets, Brian. So we agree the craziness, the noise, whatever. So and also it might be useful to explain. I know your views. You have short-term views. Good on you. You killed it with Utes. But probably a lot of folks in this room aren't as looking at the charts as closely as you are, and they won't trade daily or weekly. So when you meet like your one of your friends or a guy at the club. I don't want to say your mother-in-law because I don't know what kind of terms you are in with your mother-in-law. And they'll say, "What should I do?" And so you'll have to give them advice, which doesn't have a tenor of a week or a month, but maybe looking at the rest of the year, yada yada yada. So for the average person in the room was sitting there, the bond portfolio has done nothing, gold's gone to the moon. The S&P, the Russell's up. I don't know what it's up right now. The other day when I looked at it was up 8, and Nasdaq was flat, and S&P was only up 2. So the bigger scheme of things, whether it's rotating into foreign stocks or energy or selling your crypto or growth to value, but just getting away from the real short term. Say, folks in this room say, okay, Brian, for the next, I think a year is a reasonable time frame. I mean, look, as Yogi Bear famously once said, predictions are difficult, especially about the future. Okay, I get it. But there's an efficient frontier. There's a fine line between, on the one hand, what's the stock of the week versus Kathy Wood buy this for the next 5 years. So someone who's trying to invest and not trade, what would you say to them, Brian?
I'd say you go talk to somebody who knows what they're talking about in that time frame. That's not me. It's funny, George. I was talking in the last couple weeks about Pfizer with my subscribers, and I said, look at this stock. It's been beaten to hell. If they didn't scare you out during 2023, then they wore you out as it basically did nothing the last 2 years. And now it pays a 7.2% dividend. So I bought this stock 3 weeks ago at 20, 26, low 26. And then on this week, it broke a high from October. And I told my subscribers, I'm going to try to invest in this thing. And it broke out and it started to wobble a little bit. And if you look at the chart, you probably can't even see that wobble because it's on an intraday time frame. And I said, I'm out. I sold it. I said, basically, I got my profit. I made my profit here. 9% in 3 weeks on this one. I was fairly sized. I want to take my gain. I don't trust the stock necessarily, the company necessarily. And then I told them, listen, you don't take investment advice from a trader. And I'm a trader. I've got no business giving investment advice. I like to stay in my lane. If I'm going to talk about investing, I'm just going to tell people, stick with it for the long term. Don't worry about it. Just do your dollar cost average, do what
Right.
everyone else tells you to, or go find somebody more
Okay.
qualified than I am.
Well, Brian, I appreciate your humility in saying I don't know, which is another personality characteristic the Dunning Kruger crowd does not. That's not the way they roll. You always have to know. All right, you have to know. So you just would not have a real future in Fringe, which Brian, I regret to tell you. So so Brian, when you're like giving advice to your clients and you put out a letter, I mean, typically, are these? I mean, it could run the gamut from you could get paid right away, but like typically, like how long are people in your trades? Are they weeks, months, years? Like what tends to be the, or when you're looking at them? I appreciate, when the facts change, you change, but when you're looking for stuff, are you trying you trying to look at it on a few month basis? And hey, if you get rich quick, that's great. You get paid, you get out. But what are you aspiring to do with the time frames you're looking at?
Now, I aspire to the swing trade time frame, and that can mean different things to different people. But what it typically means for the trades that I look at, I say, listen, for a basket of your overall portfolio, if you're interested in shorter term trading, not day trading, because most people are going to lose money doing that. The majority of people are, do lose money doing that. But for swing trading, anywhere from a couple days to maybe up to 6 weeks, George, is about as long as I've
Uh huh.
guide people through a trade. And it all depends on the market. If the market keeps making higher highs and higher lows on my time
Okay.
frame, I'm going to stick with
Good.
it.
Okay. So let's drill down then. So let's everyone in this room. This is a little short time frame we usually are looking at, but I always love when the long term is nothing but a series of short terms. So as they say. So right here, right now. So I'll just throw some stuff at you. We can do a speed round. So me, I'm gonna sort of. You forgot more about technical analysis than I ever will, but I am a closet technician, but I also am more of a fundamental guy, and I believe my own bullshit narratives. So whatever. So let's start with some of the tech stuff, all right? Because that's top of mind for a lot of folks. Software can get out of its own way. It's so oversold, below moving averages. You might say it's right for a bounce. You want to catch a falling knife, that's fine. But as John Roque always intones, I think from Paul Tudor Jones, nothing good really ever happens below the 200-day moving average. So let's start with the software stocks. What does software look like to you?
It looks like garbage. I mean, you got a little bit of a bounce last week for a day or two, but that doesn't make a bottom. Looking at Microsoft, it's on a trend line that goes back to 2023, and maybe it starts to stabilize here, but it's below a declining 20, 50, 200-day moving average. And I'm a big fan of the phrase, if they don't scare you out, they'll wear you out. And I think that actually might be a Peter Lynch
Right,
phrase
right, right.
is where he
I,
first,
I,
gets credit.
I got it, Brian.
So
So nothing but words you have. If I hear you correctly, you don't have to be crazy gambling degen and go short. But when you're trying to find something to buy, like this is not at the top of your shopping list. So for you, I mean, software it sounds like, if I hear you correctly, translate what you just told me, it sounds like it's a no-fly zone for you. Like there are more dynamic things to do on the long side. Maybe it's so oversold right now you don't want to short it. Would that be a fair characterization?
100%, yeah. I don't wanna short Microsoft, but I certainly don't wanna buy it. It's dead money at best. Maybe it gets a bounce, but, there's bigger money flowing out of it on longer term time frames.
All right, let's go. You know what might be useful because you probably got your screen all set up there.
I do.
We'll do it in whatever order you want. Let's take some of the biggest stocks first. So I don't know if you want to do Mag 7 first, whatever, just run through them real quickly. So, of course, everyone, and this is important, not just because whether or not someone owns Microsoft or NVIDIA or Apple, but because if they're in index funds, these are huge components in the indices, right? So, if you could like give us a proctology exam or a health check, maybe just run through, I don't know, the top 10, 20 names, people get an idea or whatever you want to highlight, that'd be great. I think that'd be a good place to start.
Sure. Well, I mean, we can start with NVIDIA. NVIDIA has just basically been neutral here since August of last year. It's done nothing for 6 months. It's gone between 165 and 200, basically a quick little jaunt past that level in November. But it looks like, again, dead money. It's not paying
All
really.
right.
It's not paying a dividend. There's other, it's the semis are still strong, but that's because you've got Micron, you've got SanDisk, you've got these stocks that are, that have taken the baton and are running with it. But when you look at SanDisk, up from, what is this, 70, $45 in August to $600 now.
Whoa, 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 whoa,
Um,
whoa, whoa, wait. Brian, I'm gonna bust your chops. Bad joke coming. $45. Is that what year are we talking about, please?
this is August of 2025
What?
to 626. It's up 1,500%. So and people are, looking at this saying, woulda, coulda, shoulda. Where do I enter this thing? And go ahead and enter it, but be aware you're not early. And when a pullback comes, it's going to be, don't be surprised if it drops to 450 in a 3 or 4 day period, because that's what these stocks do. It's got an ATR, George. Its average percentage range is 12% on a stock that's, $600 trading 22 million shares a day. This is a big volatile beast. And, a lot of people are going to get burned by it by chasing it up here.
So, Brian, this is a good example again, not just because what it says about Sanders, but more broadly. I think it's John Roque, good mutual friend, always says, things like this, they don't correct by going sideways. Like they just, it's either going up or it's going down. So for me, since I missed it, um, I'm not going to get involved here. You know, are you in this thing? What do you? And for you, is it just in the too hard pile? Given where it is right now.
I've been in it, and really, one of my favorite for swing trades is actually a 5-day moving average. And if you look at this from the beginning of the year, it was above that 5-day moving average every day until February. What is this date? February 4th. And now it's kind of chopping back and forth above and below it. So to me, the big trend, is kind of over. Now it needs to digest, whether it's going to be
Sure,
sideways through time or a more violent price pullback. It looks really kind of similar to gold, and that doesn't mean I'm predicting it's going to, see a 15% decline in
sure.
a couple of days, but it's certainly capable of that. And people need to recognize the risks when they go into these things. They see nothing but upside and think, I mean, what do you think? You're going to buy it at 600 and it's going to go to 4,000 now just because it went from 40 to 600?
Yeah, no, that's crazy. All right, Brian, we got a lot to cover here. Let's quickly go through some of these. Let's just quickly, in the order you want to, go through some of the other big names, be it Apple, Amazon, Tesla, et cetera. So let's go through like the top 10 quickly. So maybe just you could say pair of twos, no interest. This is bad. This is good. So let's try to keep each one brief so we can get through a lot of them.
Sure. You know, Apple pulled back to its year-to-date anchor in the 20-day moving average. Maybe it's going to stabilize in here, but bigger picture, it looks like, more neutral than anything. Google is in corrective mode. I would stay away from that. Let it settle down. It's digesting a double from, from April lows. It went from 140 to 340. A little pullback down towards 270 doesn't seem unrealistic. Another 10% lower in Google.
Sure.
Netflix is just broken. It refuses to stabilize anywhere. That could be heading into the 60s. If you look at Palantir, This one is in a, it's just all year, lower highs and lower lows below all these key moving averages. I could see this testing testing par, seeing it down at 100, maybe into 95. That's the anchored VWAP from the 2024 breakout, the February 2024 breakout 2 years ago. So there's a lot of danger in these big names. That people think can do nothing but go up, and they're maybe going to learn a hard lesson. The mags itself, mags came down pretty hard from 69 to 62. It's probably due for a little bounce here right on the 200-day moving average, but there's just big trouble in this group, and let them bleed out. Let the institutions who have to buy millions and millions of shares to establish a meaningful position, let them do the dirty work of finding where the support is and building the support. And
Okay.
once it's apparent that it's done and there is solid support,
Sure.
then start to look at shorter term time frames and time your way into these and be a little bit smarter. And
All
that's
right.
what the charts are there for, to identify the opportunity, the level of interest, and then say, is there evidence here that the buyers are gaining control? Mags touched the 200-day moving average. It doesn't mean it found support there. It means here's a level. We need to start looking on shorter term time frames. But when you look at the shorter term time frame, it looks awful. It closed right on its lows on Friday. So
Yep.
um, that's how I look at them.
Got it.
And then I look at a stock like Visa that I shorted on Friday. I don't even like to short stocks, but it just happened to get this one pretty good. Looks like a huge top to me in Visa, that this stock is 314, probably headed sub 300 to 285, 290.
Hey, Brian, let me ask you. So we're gonna go do a lot more industries and stocks in a second. I know Tina's gonna have questions. I want to get O'Hare in here as well. Make him a speaker because he's pretty good. He does the work. O'Hare, I'm inviting you to speak, but just hold your fire right now. Um, Brian, so you don't have to go through every name, but when are you finding more attractive? Is your buy pile or your sell pile? Which one's bigger right now?
Um, my buy pile is always bigger, but my sell pile has grown substantially recently. The stocks that I look at when I'm scanning through stocks, I do it manually, and I'm just noticing stocks. I'm not looking for longs. I'm not looking for shorts, but I'm noticing, all the momentum names that started breaking 2 months ago, that people are still trying to pick the lows in, and they just, the quantums, the drones, the story stocks that broke first. Then we saw the Mag sevens breaking, and now we're seeing random groups get broken because of AI stuff. And I see things like, Capital Federal Financial, CFFN, I call it Coffin, breaking out to a multi-year high, and looking at a weekly chart there. There's a lot of, um, the regional banks, the KRE, while the XLF is, just broke down the way it was supposed to, and maybe is in a decent spot to stabilize. But I'm noticing, like, a lot of the regional banks. I'm seeing some of the, like, Columbia Sportswear, COLM. Amgen looks decent. Bristol Myers looks decent. So where are the stocks in the uptrends versus the stocks that are breaking down? Zoom, of all stocks, looks like maybe it's going to be ready to sustain a bigger uptrend.
Right. Okay, so a few particular ones I'm going to ask on, and then I want to get questions from the audience. Tesla.
Tesla, to me, is kind of still in a little bit of no man's land. It's maybe carving out a head and shoulders pattern here. So if you had another rally up maybe towards 440, 450, to kind of create a right shoulder, then it could break that 385 and really have a bigger problem.
Got it.
It's still got a rising 200-day moving average, as you said. That's, John Roque talks about the Paul Tudor Jones. Nothing bad happens above an advancing 200-day moving
Sure.
average to
Okay.
flip that on its head. So
Okay.
that could be undergoing distribution.
Got it. So that's terrific. What about Bitcoin?
Bitcoin is, it seems like it's ready for some stabilization. I'm long a small amount here because it reclaimed the anchor from the low that it made, that flush to 60,000. It's below a declining 20, 50, 200-day moving average. It's in a bear market, but I think it's due for a bounce up towards about 72. So I'm just looking for a trade here. If we get back below 68, then
Okay.
all bets off for me.
All right. Now a couple of the let's do a couple of I don't pick an individual name or an ETF. All right, I'll go with an ETF. XLE to kind of be representative of energy. So maybe there's a better energy instrument you want to focus on, but I could have asked about XLE or Exxon or Schlumberger. So I don't know. What does the energy complex look like to you, or the particular subgroups within the energy complex that interest you?
Yeah, XLE's monster uptrend. I mean, if you got it, raise your stops, know what your risk is, protect your gains.
Mm-hmm.
If you're not in it, it's probably better to wait for a little bit of
Okay,
a pullback in here before you want to establish. You don't want to chase up here, but incredible strength in
got
those
it.
guys for the last couple months.
Let's talk about copper. Copper. Okay, we got to talk about the metals, the precious, and the base. So the worst, the gold stock, silver all went in fuego. Huge blow off top and silver, especially. So, in the way I look at it, I know you're more short term focused, so that's fine. To me, it's multiple time frames, which, by the way, is a more general concept I want to get into here. That's when people mix up their time frames. So you could have, not you, but one might have a long term secular thesis on gold. Let's say the debasement trade. I know that's not the way you roll, but just humor me for a second. And so they'll say, "I'm going to buy gold." Okay, or the gold sucks. Okay, fine. And that may still be the case, and I happen to think it is the case. But that is not going to help you when something gets, the million standard deviations extended above a moving average. And I know you're not concerned with the super long term, but when something is, five standard deviations above the 50-day or whatever, like to me, like using the basketball analogy, it may still go a lot higher. Like I personally believe gold and silver are going a lot higher, but right here, right now, that's like taking a 3 point shot in basketball, not from the 3 point line. It's like from the mid court line. Just statistically, even if you're bullish on gold, and I know you're not right now because the chart's kind of messy, it's just a bad entry point. So people mix up their time frames and they invoke when it's going against them, in the short run, they'll invoke a long-term consideration, which is irrelevant for the short term. And I find particularly individual investors make that mistake all the time. You know what I'm talking about, Brian? No, I mean, how do you deal with that?
In 2008, I wrote a book called Technical Analysis Using Multiple Timeframes, George. Understand market structure and
Oh,
profit from trend alignment. So that's one of my you're in my wheelhouse when you're talking about that stuff. And I just wrote an article that I published this week on Twitter. It starts out saying most of the arguments on Twitter start out with people with looking at different time frames. There is we're in a bullish environment for gold, for SanDisk, but that doesn't mean you're automatically just going to be able to buy here and make money just because you're in a bull market. you know look at last the tariff tantrum, right, as they call it, the lows in the S&P 500. We officially went down 20% the day the market made its low on April 7th or whatever that was. And that's when the television said we're officially in a bear market, and that was the low of the day. These labels mean nothing without some context in
I
terms of
know, I know,
what your time frame is.
I know.
Because that day, if you bought, it was the best day to buy there
And,
was, and
and,
you're still in it.
and Brian, don't you also like similarly going back to the labeling point you made? Like there's the average, and there's the internals of the market, right? So I remember in fall of 22, the market didn't bottom till late in the year, but the internals had already bottomed months before. But the morons on I'm going to use that term, actually, it's a technical term. The morons, the idiots, the talking heads on CNBC. And yes, you know what? I'm sorry, I am going to name names. I went on a diatribe the other day with Doug Cass. Doug and I, you're going to love this, especially Teen. I'm talking to you. I'm mad as hell. I'm not going to take it anymore. So is Doug Cass. The charlatans, the enablers, they bring on these clowns on mainstream media and they throw them softball questions. Doug has written tirelessly on this. we're not going to put up with it anymore. We're going to name names. And, you
Kathy
know,
Wood.
Kathy Wood, you know, Anthony Pompliano. Okay. I mean, it just goes down the list. Okay. This is just the fact that we don't have laws or the laws aren't enforced. We have a feckless SEC. Howard Beale, please call your office. I'm mad as hell. I'm not going to take this anymore. All right. So Cass and I are going to set up, I don't know, call it a public defender's office or whatever. We will do what the mainstream media refuses to do and what the SEC refuses to do. And I know people think I'm half crazy. Now you're going to be convinced. And yeah, please, someone can quote me and retweet this. We're going to set up a public defender. We're going to have a GoFundMe page to fund lawyers to sue these assholes that are getting away with murder. All right. Michael Saylor is just what he has done. Eric Jackson belongs in jail. Period. It's securities fraud. Okay. Um, Keith Raboy, the founder of Open Door. I'm going to say it right here. Keith, come into the room. He's a liar. I have the receipts. He claims Open Doors made money. No, it's lost money every year. It's a fact, not an opinion. Doesn't matter whether I like Keith or not. He's a liar. Liar. People can come after me all they want for libel. No, that's not libel. It's a fact. He's a liar. I have the receipts. Kathy Wood, listen, Brian, you're old enough to remember when. I don't know where you were in your career, all right? Um, you know, at Fidelity, if you even thought of something which was inappropriate, the compliance Nazis would be in your office. It'd be like the thought police, right? Kathy Wood comes on, she pumps stuff. It's going to go up 30%, 40%, 50%. I remember back in 22 when we went after her, she got blown up. Nothing had changed. So the prices had gone down. And now she's saying, oh, we expect our portfolio to appreciate 60 or 70% a year for the next 5 years. Brian, on what earth, in what universe, is it legal to say stuff like that, Brian?
Especially when the numbers, don't back it. I mean, she always says back, judge us on our 5-year returns. I just saw the other day her 5-year return is negative for the ARC fund. Uh, Morningstar called her the wealth destroyer, and she's good at building a vision of this company can do this and that, and that's fine if she wants to be a commentator. But as far as managing money, she's cost people billions and billions. And the thing that baffles me is that the media will continue, and I see it, all these conferences, even the CMT conference they had a conference in Florida, and they had her as the guest speaker. Like, this lady's never looked at a chart in her life, because if she has, she's doing a handstand or
Yeah,
something. And
and by the way, I'm going to be very careful what I say here because I want to go on the record and I'm naming names. I mean, I've been advised, always better to praise individually but criticize generally. Okay. I'm not going to, okay. She has committed, she says things that nobody else would do. I believe if properly examined, she's guilty of securities fraud. All right. To your point, she has she makes predictions. They're just far enough out. It's like, not 6 months, 12 months. It's like 3 to 5 years. Over the next 3 to 5 years, Brian, what do you think XYZ is going to do? Right. So it's just believable enough. All right. But it's long enough out that she never's held accountable. All right. She belongs in jail. Okay. It's just they don't enforce the laws on her. Okay. And I'm going to name names. And by the way, I hope this room is heard by everybody. I don't care. I'm 69 years old. I know what I'm talking about. I got the bona fides. All right, enough. CNBC, Melissa Lee, are you kidding me? Melissa Lee, one of the worst of the worst, married to formerly the Baird Tesla analyst. Or you look at fawning questions from Andrew Ross Sorkin or Becky Quick, just sucking up to these people.
the
You know,
funny thing is, George, I don't watch any of that, because
no, neither
it
do I. But
angers me
yeah,
the way it does you.
yep,
But I see that they promote Kathy in particular as somebody who knows what they're doing, but her track record is she's lost billions and billions
yep.
and billions of dollars.
Brian, she has lost more money for investors, I think, than any other mutual fund manager in history.
That's what, according to Morningstar, they're the expert.
Yep,
They called her the
yep,
wealth destroyer. I'm
yep,
not saying anything
yep,
that's not
yep.
that somebody with more
All right.
information than me hasn't researched aggressively.
All right, so Brian, I know right now I need to go sit in the corner and take a deep breath. So I'm going to turn to my friend O'Hare.
Wait, I got a
Well, all right,
question. Don't go to O'Hare
okay,
yet.
all right. Tina, you go first. Tina, can you run the room for the next 5 minutes? I just want to kind of like
Sure.
decompress.
But
Go ahead.
these are actually some broad questions, not about specific stocks. I'm really interested. I don't know if you noticed, Brian, but I put your technical analysis using multiple timeframes and your anchored VWAP book up in the nest. You
Oh,
see
I
that?
didn't see that. I don't know where to see this nest, but thank you for doing that.
You look up above, and most people who come to Spaces know how to do that. Those are two of your books. I read Anchored VWAP. I have to read it again. It's very meaty. I don't know if I read all of it. There's a lot in there. It's a great book, and people should read this. These are
Thank you.
generalized questions, and rather than asking about specific stocks, the first one is trying to choose between stocks in a strong uptrend, um, or looking for things like relative reversals, like looking at XLE divided by SPY and looking at relative strength reversals. Which do you tend to like? And then another broad question, what are you looking for in tops? And then lastly, do you ever use volatility as any kind of a guide into uh, this kind of work? Because I think these are all important questions rather than just talking about specific names. And I know people are interested in specific names. I'm more interested in taking advantage of a man of your caliber who's knowledgeable in technical analysis. And so, do you mind doing that?
Not at all. I'll tackle, volatility first in that I don't really look at the VIX. I think that's only useful when we start to see extreme measurements. But following the VIX on a day-to-day basis and trying to, gather insight into it is, to me, I think a lot of people waste a lot of time there. For me, in terms of volatility, I use it as a measurement of more kind of position sizing and an expectation of how I can manage risk in a stock. So I look at a percent ATR. So I want to know, the ATR of the average true percentage range of the SPY is 1.3%. For Tesla, it's 4%. For a stock like Oklo, it's 10.3%. So I know that, I should expect a 10% range and I need to be prepared for that type of volatility. So that for me, that volatility is just, serves the purpose of telling me how do I manage risk. Um, in terms of, ratio charts and, the XLE divided by the SPY or whatever, I'm a more of a bottoms up stock picker. So I go through, I've been doing this a long time, so I can go through a large list of stocks quickly. And when I'm doing my scanning, what I'm trying to do is listen to the messages of the market and listen to as I go through this large list, I start seeing, stocks like CFFN that I mentioned earlier, that it's some weird little regional bank. It's got a great looking chart. And then I look down my list and I see, four other regional banks. So to me, it says I'm starting to see strength in this group. Then I might go and take a look at KRE or whatever the, regional bank is. But I don't like to do the ratio charts, the Bitcoin versus SPY. I can tell that Bitcoin is weak relative to SPY. You don't need a ratio chart to that. And as far as I know, no one's ever taken a Bitcoin or S&P shares and bought Bitcoin with them, or gold or whatever. So to me, it's more bottoms up. And the third one there, Tina, was what you said.
Topping. Oh, but by the way, so does
Oh,
that?
topping.
So do you put any value on relative strength? Do you look at relative strength at all?
To me, it's kind of absolute strength. So is this stock? So
Well,
my.
I look at IBD a lot, and their
Mhm.
relative strength seems to be kind of absolute strength. That's why I'm a little confused, and I don't know if other people are sort of confused on some of these technical terms. I don't necessarily know how these are constructed. So
Sure. So IBD is the relative strength index, or I'm sorry, the relative strength of that stock versus, I think the S&P 500. So if I see a stock with a 99 rating, to me it means it's already probably played out. SanDisk probably has a 99 relative strength. It's one of the strongest stocks out there. To me, the sweet spot, if I'm looking at relative strength, seems more like in the 80s and it's increasing. So I'm looking for an increasing relative strength. So I'm looking at stocks that have broken out of maybe a long-term base in the last 6 months and they're in established uptrends. Then I want to monitor those pullbacks for the proper, low risk entry into those. So it's more of again, a bottoms up approach to start out in how can I manage risk here individually. And when it comes to topping, you could argue that maybe the Nasdaq is making a top in here, and maybe it is. I don't know. I just see a market that's either correcting sideways through time since mid October, or really, September. We've been in this range, and calling it a top is tricky because it can break down and quickly
But when
reverse back up.
focus on groups and names, because picking the top of the market, S&P has gone sideways now since October, but there's a lot of destruction underneath. You've seen a lot of names that have been absolutely blasted to hell. So it's not necessarily showing up in your averages when you're looking at big tops, things like Qs and SPY. But you'd be taken apart in a lot of names.
100%. And I was, so for instance, Visa. As I said, I'm short Visa right now, and I was also short Visa in November as it looked like it was breaking down. I got out of Visa because it reversed back higher. So it broke some important support at 335. And from that failed breakdown, it ran very rapidly to 360. And I didn't stick around for that. It came back down, it distributed. And as I said, I got short on Friday. Now, to me, it's up to the stock to tell me whether I can continue to hold it or not. I think that if you look at a weekly chart of Visa, it looks like it's headed to 290. But if this stock reverses back up through Friday afternoon's high of 319 and a half, then I'm going to cover my short. That, I'm not interested in what happens after that.
So Brian,
So
so Brian, just so thanks, Tina. So Brian, is just to get a word about where people can find you and everything. So if someone's takes your service, this is the type of thing you do, like you'll give a recommendation and then you'll have stops. And so, like for instance, if you said you went negative on Visa on Friday, I presume you communicated that to your clients and um, they understand this is short duration stuff. So they shouldn't be shocked if conditions warrant you may be out of this trade in a week or two from now. Is that fair?
yeah. So this was a trade that was outlined Thursday evening as a short. We were looking for a little bit of strength and then to short it, and we got that. And then covered a third of it at 316.75.
Right.
So took that first third off with a gain of $7 and $7.50 per
Okay.
share. And that's, just so now I'm in a position of strength in this stock.
Got it. Okay. That's
Half of
fair.
my stop, so then I'll update the stops. Half the stop is 324, half of it is at 319.45. And if the stock continues to decline and make lower highs and lower lows, I'll ratchet those stops down until the stock
Got it.
stops me out.
Got it. All right. Let's keep moving here. O'Hare, what's on your mind? O'Hare, are you there? I don't know if he's there. He's probably.
Yo, what's going on, guys?
Yo.
I'm here. Yeah, I'm just
Hey,
listening.
you
What's
got
happening?
you always do the work. So here, you got some questions for Brian?
Uh, I do. I might have a question here. I haven't really ever spent time with Brian on X here. I know who he is. I've seen some of his work in the past, so it's kind of cool to see him up
Likewise,
here.
yeah.
A couple things I guess I'll tell you. I've been doing this since like the mid '90s, and when I was a young kid, I was like in my early 20s before I actually had a job on Wall Street. I was already I used to hang out every Friday night. This is again before the internet and stuff, 95, 96. I used to hang out with my girlfriend, who's my wife at the time, or now girlfriend at the time. We used to go to Borders in Marin County, north of San Francisco, and where we lived. And we used to go to Borders every Friday and spend literally 2, 3 hours till they closed after work. Both of us would meet there and have coffee. I don't know if you guys have ever been there, but they'd have a little coffee and espresso place, and you can get pastries and stuff. And what I would do is I would get all these magazines from their business section, including and mostly technical analysis of stocks and commodities.
Hmm.
Um, and I loved reading that rag. And it was quite expensive at the time to get a to order it. So what I would do is just go there every Friday, and just read it. And I would literally just every page by page just go through it and read the articles. And it was just fascinating to me. And then I'd grab books off the shelf as well and read those. So that's kind of how I got my, I already had an interest for investing and trading, but I just remember fondly, those days of reading that magazine. I'm sure you've read it many times yourself.
Yeah, of
Um,
course. In Borders bookstores for some of the people that probably don't even know that. And it used to be BGP, I think, was the symbol.
yeah, they went through a bankruptcy and everything.
So yeah, here, let me just jump in 1 second. So Brian has like 20 minutes left. He's got a hard stop at 12:25. So here, if you got a question for Brian, that's great. Otherwise, let's just keep moving on to other people on the stage. You have a question for Brian O'Hare?
Well, so yeah, a couple questions maybe. So at that time, there was a guy that I would as I would get as much information as I could about him, which the guy's name is Richard Dennis.
Hmm.
And you're familiar with him, I'm sure. Many of people in here listening are probably not, but so I was fascinated by his methodology, and kind of what he did and the whole turtle trader thing. Now, I'm not a technician myself. That's not what I do. My partner and I manage a value strategy, so we're deep value guys. But we do utilize technical analysis. Something you said earlier when I first hopped on here, you said something about Nvidia. That's the first stock you guys talked about, and you said it's kind of been trending in a sideways thing since last year, up and down about a $50 range, I think, is something like that, $60 range. And I just want to ask you, it sounds to me like you're more, and I may be wrong, but you can correct me. Are you more of a trend follower type versus a
Yeah.
like a true technician trading to up and
Right.
down, more of like a finding direction whether up or down and trading that pattern, similar to what Richard Dennis taught. Is that kind of how you're wired?
I am a 100% trend trader. So I'm looking for stocks that are in an established uptrend. They might have pulled back for a week or two, found support, and then as they start to turn higher again, I want to get on that momentum. Or on the flip side, like Visa, it's
Hmm.
below all. It looks like it's made this big distributional top. It's below all the key moving averages, and it's teetering on the edge. I want to be there for that breakdown.
All
Hmm.
right. All
Yeah.
right.
And do you change your parameters? Like, for instance, you talked about a 5-day moving average versus like a 10-day. There's all these tweaks one can make. Do you stick with a particular strategy that's worked, or do you find yourself having to tweak the parameters given the kind of market backdrop we've been in over the last, say, particularly 5 years since COVID?
I really don't tweak it too much. I mean, so I learned it from Stan Weinstein, Secrets for
Hmm.
Profiting in Bull and Bear
Hmm.
Markets, the cyclical analysis, which was based on the work of Wyckoff. And, those, that cyclical nature occurs pretty much on every asset. And you can see it, through the fractal nature on different time frames. So when I can find that alignment, whether it's in a short of Visa or a long of Bristol Myers, or whatever the case may be, then I want to hop on those trends that can last days to, as I said to George, maybe 6 to 8 weeks is a longer term hold for me.
Hmm. And then lastly, I'll ask you, and then we'll go to George, and you can bring some other people up. But I think for me anyway, I don't know about you, but for me, the best tech, if you're going to be a trader, especially like a intraday or like a swing trader, probably the two best things to look at right now are Bitcoin, which is purely technical based, in my opinion. Check Bitcoin, and I want to get your take on gold and silver. What are your takes on those three
Yeah. So
assets?
here, let's keep it simple. So he doesn't like Bitcoin's in a bear market. No interest, although it may have a little bit of a bounce here. We didn't really get into gold and silver very much.
Oh, yeah.
So why don't you do gold and silver? That'd be a good place to go.
Sure. Gold, I mean, gold is still in an uptrend. It kind of reminds me in a way of some of these. George, you remember Qualcomm when it had its big run back in the days, and it ran up to that, it was 1,000 at the point, and then it pulled way back, it pulled back 20, 30%, and then it ran to new highs again. I think gold is still technically, we've got a rising 20, 50, 200-day moving average. We're holding in a tight range here above the year to date anchored VWAP. I would not be surprised to see gold at a new high here, relatively near term. And then I think we're going to still see some volatility shocks as it settles down a little bit. It's got a huge run to digest. And silver is not quite as bullish. That one I could see kind of drifting out a little bit here. I don't like the fact that it's below the year-to-date anchored VWAP and it's below a declining 20-day moving average. So gold is, more favorable. So if someone was going to do a relative strength chart, I mean, I can see that relative strength chart in my head. Gold is clearly outperforming silver. You don't need a ratio chart to see that.
Got it. That makes
Appreciate
sense.
it. Thanks, man. Yeah, I
That's
agree.
awesome.
Yep.
That's awesome. Okay, appreciate it. Thank you, O'Hare. All right, let's keep moving here. We're going to go to John McClellan, and then GM Global. John McClellan, please unmute yourself. John, you there? I don't know if you're there. Okay. GM, good to see you, man. The floor is yours.
Yeah, hi guys. Sorry, I'm just on a run. Brian, thanks very much for showing up. George, great space. Here's my question. What are the top 3 indicators that you believe do not work, except that the market or the legacy crew, if you will, believes that they in fact do work? And because of your work and back testing, can you name the top 3 indicators that are a bit of a fallacy, yet everyone continues to use them on a daily? Thank you.
Yeah, good question. And I really, and that's an extra good question because it's not something I've considered, and I certainly haven't back tested it. I will say that, seasonality tends to be something that people think is a certainty rather than, I call it a time of interest. So, we've seen the Santa Claus rally, I think 3 years in a row, be a complete dud. And people were somehow expecting it to be guaranteed profits. Um, when you look at things that, why do they work? Why does a 50-day moving average work? I like to talk about the psychology of that. Is that it's not necessarily a self-fulfilling, but maybe self-reinforcing concept. So when silver ETF runs from 30 to 110 and pulls back and starts to stabilize near the 50-day moving average, why is that? It's, as George was saying, if it's 5 standard deviations above it, well, it's going to attract certain short sellers. And those short sellers are going to short at that 5 standard deviation level. And they're going to say, well, it should pull back to the 50-day moving average. So we'll stop selling short, stop, adding supply, and we'll start to put some bids in near that 50-day moving average because that's often where support is. So we get a little bit more demand. Then we get people on the sidelines saying, well, shit, I missed that huge rally in silver. It's pulled back to the 50-day moving average. I'm going to stick some bids in there and see if I get filled. More demand. Then you're going to get the people who didn't sell at 110 and then say, well, it's down to 70 at the 50-day moving average. I can't sell now. So it just becomes this self-reinforcing. If we can understand the participants and what they're doing in these zones, these levels of interest, and start to see that they're kind of coming to the same conclusion, maybe for different reasons, but it becomes self-reinforcing. So I don't I wouldn't say that, the MACD doesn't work or the relative strength doesn't work in that regard. But I look at them and say, why do these things work? Are there enough people looking at them? Is there some mystical Fibonacci thing, or is 61.8% often support because there's enough people covering their short at that level and new money coming in to buy and other people, stopping, their activities in that zone as well?
Great
Does
question.
that answer that?
We're good. That's true. Let's keep. I want to keep moving here because we're up
Sure.
against the clock constraint. John McCullen, are you there? I don't know that you are. Okay, we're gonna go to Nasser. You're coming later. We're going to Empty Cup and then Nasser. Empty Cup. What's your question?
2 really quickly. Just Brian, how do we like using historic volatility in order to discover bear and bull tails? And on what time frame, or is that relative to the underlying asset itself?
It's not something that I do, and I'm not really sure exactly how you mean. So, to say, typically the ATR of this stock peaks when it's, at 12% or something like that after a 6-month run. It's not something that I really do. So I can't really I'm not sure I understand the question properly.
Okay.
Actually,
Oh, that's okay. And then I'll delve more into it. I guess that's my own responsibility. George, I wanted to circle back to last week's discussion or spaces you held was wonderful.
Yep.
And it was in regards to something Bitcoin Tina pointed out towards the end of it. I posted it down in the nest where it is the margin debt as a percentage of total market capitalization. Well, he also posted something about the things that are considered outside of that. So I just ran it to Grok and said, show me what it is if we include all this other debt where it's, private credit, ETFs, shadow leverage from swaps. And the percentage shows much higher. So does that, given everything we know about the current markets, defensive rotation, et cetera,
Sure.
how does this change your viewpoint on the timeline of, does it accelerate your timeline of these or the drasticness of these moves?
So that's an excellent question. And it's funny, I saw your post this morning. I actually made a couple of calls to Adam Parker, Cantrell, a couple other people who have the numbers on this stuff. Because clearly it's a point, it's a focus point. One thing I would point out, Bitcoin had some great stuff last week. You just can't add all these sources of leverage together because, someone who is, for instance, like for instance, if you had took a leverage long ETF and said, well, let's add that to the margin debt. Well, the leverage long ETF is, you got to avoid double count, I guess is what I'm saying. So,
Oh, for sure. But I'm just
yeah,
meant
well,
as an
hold on,
approximation.
yeah, no, well, hold on. It's a deceivingly difficult question. It sounds simple, but it's hard to answer. And so you're asking the right question. I don't have the answer. Okay, so
The construct, George, the construct of things like the leveraged ETFs is they reset every day. So they actually get bigger as the market is
yeah,
moving or one or two markets move.
it's I know, but
Yeah,
that's,
yeah.
but just hold
But
on.
that's part of the problem
Yeah,
with
I know,
traditional.
I know. So what we need to do is get someone like Cantro, someone like Adam Parker, someone like Michael Goldstein, Empirical Research. They're much smarter than all us schmoes in this room. They got all the data, and we'll get the answer. I mean, the question being asked by Empty is the right question. We just can't give a pat answer. I don't know the answer to that question. Okay, so but what we do know, all right, is like on the raw data basis. Let's keep it simple. Let's go back for a second. So for those who weren't in the room last time, when you look, people say, oh, let's just. I want to first set the question up because people really understand what's at issue here. The answers will come later. People say, "Oh my God, look at all the margin debt. It's terrible. The margin debt's gone up. So therefore, the market has to go down." No, that would be like looking at a chart of mortgage debt. All right, like if the value of the houses go up, the value of the housing stock goes up. You would expect the value of the size of the mortgage debt standing to go up. People buy a new, more expensive house. They take out a bigger mortgage. People do a refi, right? So if the value of a house, if the value of houses, let's say over 10 years doubles, I'm just going to make up numbers, you know, you would expect the mortgage debt to at least double. Otherwise, they're becoming less geared. So again, this is Capstone 101 obvious, Capstone 101 obvious, Furu, Dunning-Kruger Finance Institute, baseball cap on backwards, 28-year-old kid in the basement, or Kobe SC letter. Okay, I'm naming names. All right, this is not analysis. Stan Weinstein, and Brian, you're a fan. I'm a fan.
Mhm.
You know, and I should actually ask Stan, what you got to look at is margin debt as a percentage of market cap. So that's a simple answer. But then the question that Empty's bringing up is like, okay, and Tina spoke about this last week, you just can't look at the simple margin debt. Why? Because you have leveraged ETFs, you got futures, you got this, you got that, you got all these derivatives. So it's just like if you looked at the housing market in 2008, it was the size of the derivatives, which was multiples of the spot, which really caused the problem. And so, Empty, you're an annoying guy. It's a compliment because you asked the right question. We just don't have the answer. That's all.
Well, that's
George,
fine.
can I piggyback on that
Please,
question because
please,
you might
please.
have some insight into this? I find it similarly frustrating to find short interest with all the different ways of getting short exposure. That
Yep.
it used to be a simple number that here's how many shorts are out there, and we really don't know, or I don't know of a way to truly know what the short interest is.
Correct.
And you have things like call walls and put walls,
Yeah.
and you have activity. The option market is enormous and has enormous
Yeah,
impact on all these.
exactly. So, and by the way, Bitcoin Tina, and by the way, Bitcoin Tina, you're not allowed to respond to this question because I know I'm going to trigger you. I'm going to say it anyway. Okay. One of the problems with Bitcoin, one of the many problems with Bitcoin right now, it's not just regular Bitcoin, it's derivatives market. And again, that's so much bigger. And so all these markets, the hyper financialization, the derivatives, a lot of these old indicators don't work anymore. But by the way, as long as we're talking about loss of truth and nothing matters anymore, I'm going to really throw a log on the fire here. You can't believe the government statistics on anything. You can't believe any of the numbers. That's what people go on and on, endless in these spaces. Oh, inflation is this, the GDP is that. And this stuff all gets revised a year later. It's like, let's win their IQ contest, you know? And Brian probably will make this speech. I don't mean to steal his thunder. There's only one thing that doesn't lie, and that's price. All the other stuff is mental masturbation. All right. You have
Right.
all these geniuses. We're gonna have a special space at 8:30 to discuss the CPI number and the inflation number. Okay. And they get some bloviating fool who used to work at BlackRock or Bridgewater or whatever. Oh, I was at 0.26 and it came in at 0.22 when you were at 0.29. Complete freaking waste of time. Gnostic. Gnostic. Where are you, Gnostic?
Oh dear, I'm here.
Come on, stop me. I'm getting amped up here. Go on.
Well, you took away half of my question to Brian, but so Brian, here's the other part of my question, and I may be phrasing this wrong or a little confused, so please forgive me. Um, in doing the technical analysis of things, how much the market moves, somebody goes in, buys, does all the rest of it, and a stock starts to move. The fundamental, the analysis, the momentum, all there. But at what point does technical analysis become a self-fulfilling prophecy, and the more people that follow the technical analysis becomes the self-fulfilling prophecy, proving that it's actually accurate, versus things that move outside of, say, the self-fulfilling prophecy of technical analysis? So
Sure.
pardon me if I phrased it wrong, but
No, I get it. And again, I would kind of just go back to the psychology of what's going on at those levels and trying to understand that. And what I because it's so widely known a lot of times, what I often like to see is, the retest, the little shakeout that we get, and the little traps that occur near those obvious levels. When in no disrespect to Michael Burry, I don't know anything about the guy other than he gets a lot of media. But when someone like him starts to talk about a head and shoulders top, then it makes me think, well, maybe what to quote Granville there for you, George. What's obvious is obviously wrong. Maybe that head and shoulders pattern isn't going to play out, and instead that we're going to break the neckline and then reverse quickly higher. So I look at it, and I like it when those traditional patterns and that sort of thing kind of fail in the obvious area, because it lays way, paves the way for from failed moves come fast moves, and we get and while people are still scratching their head wondering why this head and shoulders pattern didn't work out, the stock rallies 8% in 4 days, and then it rolls over and gets the bigger move down. So to me, it's more about, okay, here we're in a key area. A lot of people are seeing this. Now it's in the mainstream media that this head and shoulders pattern, and people, forget what a head and shoulders pattern is. It's simply, we had a pattern of higher highs and higher lows. Then we see a lower high, and then a lower low breaks, and then that's your neckline. And it's just, we've reversed from higher highs and higher lows to lower highs and lower lows.
Hey Brian, you know what? I want Nasser to get one more question, then I know you got to run. We're not going to close the space, but you've done more than help us, Brian. Listen to the way you speak. It reminds me of my Greek friend Stavros. I don't speak Greek, but it's something like it'll show itself. So in other words, the market will show itself. Like, don't predict, just it will show its hand, and I think that's probably a much better, certainly more intelligent, risk adjusted way of doing things, rather than outspoken clowns like myself have big opinions, narratives. Then it doesn't do what you thought it was going to do, and then I'd say, "Well, Brian, turn the chart upside down. See, and that now it's doing what I told you it would do. You know how that works, right?" So, I think the idea that it'll show itself. I think that sounds kind of like you're letting the market reveal what it has in store for us, rather than you trying to force your opinion on the market. Is that fair?
I, I I think that it's communication, and as they tell us that in successful communication, we need to listen more than we speak, and that my job is to listen to the market, not to tell the market, "Hey, I want stocks that pulled back 3 days on lighter volume," and that could be a good pullback scan to start with, but to listen to, hey, it looks like these utility names are starting to creep higher, rather than saying, well, we have interest rates doing this, therefore I'm going to start to look at interest rate sensitive stocks, and notice what the market's telling us rather than
Right.
but and that's not it's I don't mean to make it sound easy either. I've been looking at charts every single day of my life for the last 35 years obsessively, and I've gotten very good at listening. So it's as always, it's never as easy as it
Hey,
sounds
hey,
when somebody talks about it.
Brian, wise guy question. Would your wife say you're a good listener?
Sometimes, yeah, and that's a great question, because I think of that often when I'm ignoring what she's saying, and I'm preparing my response.
Yeah, I'd be pissed if I were her because, like, you're listening to the charts, but you're not listening to her. It's like, good luck with that. All right, listen, don't go. One last thing. Gnostic, I'm going to give you the last crack at Brian, and we're going to keep the room going, but Brian really has to run. So, Gnostic, why don't you finish off what you were saying?
Well, George, you kind of did one of the things that brought me into looking at charting a long time ago when I was sitting down trying to do an analysis of something, and the girlfriend walked in and said, "Well, what are you looking for?" And I described it, and she literally turned it around and said, "Well, there it is." And I just it floored me.
Hmm.
I had to sit down and go, "Oh my God, I'm looking at it the wrong way." And that's literally when I started listening instead of trying to move in advance. So Brian, I understand where it is. The reason for my question is I'm getting people coming back and saying, "Hey, there's a reverse head and shoulders going on in silver now," and you start looking at it and going, "Huh?"
What time frame? Yeah, what are you looking at?
That's exactly yes. So anyway, do you chart the commodities at all and in silver, and do you look at silver?
I do a little bit, only because they've been so active that I've been drawn into them. Typically, it's not in my wheelhouse. I did a tweet the other day about the dollar amount that is traded in GLD versus the gold futures. And 95% of all the liquidity is actually in the futures. Only 5% trades in the GLD. And everyone's looking at the GLD wondering why, it gaps and that sort of thing. There aren't real gaps. You have to look at the futures itself. I think there's been three small gaps in gold in the last during this run, versus every day gold GLD will gap because it's a 23-hour market versus a 6.5-hour market. So I find them a little bit flawed in that way, and I don't want to be, up all night trading these things and worrying about them. So I try not to be involved in commodities so much.
Got it. All right, listen, just hold it right here for a second. We'll go for a few more minutes, but Brian, it's been fantastic. One last thing for you. Where can people find you and your work if they were interested in your services?
Sure. I mean, right here on X Alpha Trends, and then you can look at my username, and anything else I do is kind of linked up there. So that's pretty simple.
Good stuff. That's great. Brian, thank you so much. It's been awesome. And hopefully we can do this again in a few months. And, there'll always be a market and things will change. So we'll have something else to talk about. So thank you again, Brian. Enjoy the rest of your day.
I enjoyed it. Thanks, George.
Yeah,
Thanks, everybody.
that's great.
Bye.
That's great. Okay. John McCullen, are you there? We've tried to get you in a couple times, but I think you're MIA. I don't know what's going on here. All right. So I'm going to remove you. So now let's go to, we have patient. Sorry, who's it?
Back
Who's this? Hello? Who's speaking?
Yes, may I interject and circle back to the
No, you're
leveraging?
hold on. No, hold on. Your connection's really bad now. We're having a hard time hearing what you're saying. So, can you do me a favor? Could you leave the room and come back, please? Leave the room and come back, please. Let me hear. Hold on. Anyway, there we go. Hey, Brian's been at this for a long time, and I read his stuff. I think he's great. He's probably more short-term focused than I am. There's no right or wrong answer. Those who have a more intermediate or longer term approach may not find his approach of use, but he will keep you in gear. You will not get caught with your pants down with Brian. He may not have, he may not go yard in a name like, John Rowe calls us, I think gold's going to go up a ton, silver's going to go up a ton. And he's willing to ride the ups and downs. So both approaches are valid. There's no right or wrong answer. But Brian does a great job, and I urge everyone to take a look at what he does. Patience, are you there? You've had your hand up. Patience, did you have a question? Patience? Guess not.
You got to have some patience with him, George.
Yeah, I know. Hey, Bitcoin Tina, what was your takeaway? What impressed you from what Brian was talking about?
That's a great question. I found it mostly quite interesting. I was really more interested in more generalized questions because you got a guy here who really knows a lot.
Sure.
And actually, I would have pursued that a little bit more rather than individual names. I think more people want to hear individual names,
Right.
but I'm sort of rethinking how I want to do things.
Yep.
And I think that in like one of the things that I'm doing right now as we're sitting here is I subscribe to another service, is I'm listing every name in that service, which is basically all the stocks. He says he looks through all the names, and I think he makes a really great point that looking at a lot of names gives you a lot of information on the market. I think I personally over focus on the big indices, and I think that doesn't actually contain a lot of
Yeah. So
information.
let me
The information
let me
is under the
let me
waves.
respond to that. I know from those 40 odd years, I need to look at individual names. If you look at the indices, oftentimes it misleads you. And also, if you really want to make money, you make more money in individual names, you're looking for the dispersion. So, if the index is, say, going up 5-10%, there's some stocks going up a lot more, some stocks going down. So there's more juice, more idiosyncratic opportunities, individual names. And oftentimes you can have such wild dispersion that you think you're in a totally different universe. So look like the last few years, tech was up and to the right relentlessly. Meanwhile, if you're sitting there with healthcare stocks or energy stocks or some value stocks, retail stocks, regional bank stocks, you're getting destroyed. And so just looking at the indices doesn't really tell you a whole lot. And so, as Peter Lynch always said, it's a market of stocks. And I can't urge everyone strongly enough to focus on stocks, not the indices. But I think both are informative. And so when someone says to me, George, what do you think of the market? I have a market view, but it comes from the bottom up. So if I said to you, Tina, you know what? I don't like tech. It's 30% of the market. I love energy. Love energy. Couldn't be more bullish, but that's only 30% of the index. I don't like the consumer stocks, and I don't like the communication stocks, and da 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 da. I can, on a bottom up basis, tell you what the index is going to do, but that's really not interesting because I don't want to invest in the index. I want to invest in the horse that's going to move the most. And on that basis, you got to look at stocks and individual sectors if that's any help. So I couldn't urge you. You know what would be helpful, Bitcoin team, I think? I mean, it's a little more work. It's not as much as individual stocks, but if you just look at sector ETFs, that's a bit of a help. I mean, look, let's be real here.
Oh yeah, no, I totally
Yeah.
agree. I totally agree.
Yes. But and then you have stuff like the indices. Like, give me a break. I mean, the Russell. What a pile of garbage that is.
By the way, George, I apologize for doing this, given the story you
Sure.
told about energy is not 30%. Energy is three
I said
percent.
3%. You misheard me. I said
Okay,
I said tech is 30%. Okay.
okay,
Sorry. Okay. All
okay.
right. So at any rate, let's go now. But let's go back to empty patience. You wanted to ask about the leverage thing. Do me a favor. Do not ask the question again because we know the question. We just got to get the answer. I know where I can get the answer. So if you could hold the question until next week, I'll have you the answer. All right. It's bugging me now. Now that I heard that question, I can't unhear it. All right. So I got you. All right. Patience, did you have a question? Patience. Patience, I'm running
No,
out. Yeah, what's your
I
question?
don't have a I don't have a question.
What's the question? All right, patience.
I don't have a
All right, we're removing patience because patience is not legit. It's the second time. No, no patience. You two strikes and you're at, not three
George, you
strikes.
ran out of patience.
You already had patience. She does not get 3 strikes. She only gets 2. Sorry about that. Empty, you're allowed to come back, but don't. But you cannot ask a leverage question, okay? Because I already told you we don't know the answer. Okay, so don't ask it again. Like I hate when people do that. All right, anyway. So moving on. I don't know if there's anyone else has other things they want to talk about. We've been going an hour and a half. I guess getting away from the daily volatility. Just a couple of tells, things that caught my interest this past week. So here I want you to talk about this. You probably had the same reaction I did. Okay, when I saw Google issuing that 100-year bond, like the hair on my back started. I don't have much hair on my back, but let's just say I started to twitch. I'm like, So to me, that was a tell. They're able to. I think the bond was a 100-year bond, oversubscribed, pretty tight spread. That's a tell. As I like to say, those are things you don't see at the bottom. I think everything's coming together now for the wheels to really come off the AI trade. It's only a matter of time before you start seeing some cancellations of. I got to remove patience. Patience. I'm out of patience with patience. I just throw her out of the room. I think the AI trade is a borrowed time. The semis are doing fantastic, but the hyperscalers not so much. That's where the market cap is. I love, love, love these neocreds on the short side. Also, the Dunning Kruger financial illiterati, all the guys with the baseball caps, the 28-year-old Eric Jackson disciples, they all love that garbage. All right. Everyone should go see an interview Jim Shannon did the other day explaining what a disaster these things are. And Nobody Special put it best the last couple of weeks he was in here. I think he got the line from Ed Zitron. He was talking about the neo clouds. They're basically WeWorks with GPUs. WeWorks with GPUs. All right. So the fact that Eric Jackson and all these clowns are recommending it's like if I wanted to be short these stocks, like what would I look for? Like if smart money was involved, I'd be like, well, wait a second, Seth Klarman owns this or George Soros owns this. That'll give me pause. But you have the worst investors, the worst narrative chasing financial illiterates owning these stocks. So, and again, I hope everyone hears this. And if people get pissed, I don't care. I'm stating facts, not opinions. Facts. So anyway. Here, anything else you want to talk about or Bitcoin Tina? Otherwise, I think we're gonna close the space.
Nothing for me, George.
Good. All right, I'm kind of
Yeah.
tired. Otherwise, I would keep going.
You know,
Here, do you want to say
well,
something here?
no,
Sorry.
you brought up Google. That's an interesting, occurrence here. You have to remember Google, that bond offering, the 100-year bond that everybody's talking about. That's a small portion of the total tranche. I think it was like I don't know, just a few, like maybe 2 or 3%. I think it was less than, I think it was less than $1.5 billion, $2 billion of the total, and I think it was 20 billion or something. So, but it is an indication of kind of the demand because I think what I read was it was way oversubscribed. That 100-year tranche was way oversubscribed, so there's a lot of demand, and the reason is because it carried a much higher coupon. So there's an appetite. So this is an indication to kind of what you were leading to. This is an indication of yield appetite on the part of investors. You have a company that's a triple, it's effectively AAA rated. It's nearly a $4 trillion company with massive amount of cash flow issuing this debt. Why not? Why not buy it? I mean, it's as we say in this business, it's money good. So if I can get a 6% coupon, I don't give a shit if it's 100 years out or if it's 10 years out. Um, so I think it is an indication of kind of overall environment, but I wouldn't read a lot into this particular one because again, it's very, very small. But I think what they're doing is testing the waters. I think that's probably what's happening here is,
Yeah,
they're testing the waters.
I take your point that it was small, but my point still stands. The fact that anyone would buy that to me is a tell. I mean, to
Yeah,
me,
yeah,
that's
for
like
sure. Yeah.
that's like the Austrian bonds. Remember the zeros a few years ago? The Austrian bonds, I think they're like 80% or something like that.
Hmm.
Zeros, Austrian zeros. You look back in history, anytime something like this has happened, it's always a great contrary indicator. And so, I think liquidity is starting to dry up for a lot of this AI stuff, and I think you're going to start to see cancellations. And oh by the way, I have no position in semiconductor stocks. They're incredibly powerful, good for anyone who's owned these stocks. More power to you. But God forbid if you see any cancellations on any of this stuff, these stocks are going to collapse so fast it's going to make your head spin. So, when Brian was talking about SanDisk going
Hmm.
from 45 to 600 or whatever, since I was joking, I said, since which August? August 8 months ago, not
Right.
10 years ago. I mean, that's just craziness. So, do you feel lucky, punk? Fine, have at it with the semiconductor stocks. But
And
and I know,
anybody that tells you this isn't like 99 wasn't around in
I know,
99.
I know, I know, I know.
But the materials are also going to drop too, because a lot of the materials, there's nuclears, there's a lot of stuff that's
Tina,
not just
Tina,
semiconductors,
Tina,
right?
you're totally right, which is why I think nuclear stocks are freaking AI plays. Let's be clear about this, all right?
Right, there's a lot of stocks that are AI plays.
Exactly, which is why when the AI narrative, when the wheels come off the AI narrative,
Are they going to
it's
get
gonna
nuked, George?
when the wheels come off the AI narrative, it's not just going to be the hyperscales again. It's going to the repercussions are going to be felt far and wide. All right, just hold on, everyone, stop. We have one new guy in here, and then we're gonna do Blake, and then we're gonna do Gnostic. Blake, what's on your mind?
Yes, sir. Just want to thank you and then ask a question of you, if that's all right.
Yep, go
You
for it.
made a you made a post about the pension exposure to MSTR,
Yep.
and it was a brilliant post. It was detailed. I just want to thank you. I'm a firefighter. I got a pension,
Sure.
and it's insane the exposure that these major pension funds have taken with this turd of a stock. And for you to point it out publicly, I just want to thank you
No,
for that.
I appreciate that. As I think I saw your response to. Everyone knows. I mean, the absolute dollars involved is not the point. It's tiny. It's not the point. The point is the analytical malfeasance. I mean, if anyone did that working for me, I'd fire them immediately. And that these people are drinking the Kool-Aid and engaging in this rubbish should really make people think long and hard about who their fiduciaries are and are they being well served by those fiduciaries. Thank you for the compliment, Blake. I tell one funny story. So you just triggered me. It reminds me of a great story. But Jeremy Grantham in 1999, GMO, value investors out of Boston. Don't worry, I got plenty of problems with Jeremy, but that's a different story. Grantham Mayo, in the run up to the tech wreck in 2000, they did not own the tech stocks. And if you didn't own the tech stocks, you were nowhere. So Grantham started losing assets, not because their funds were declining in value, but they were seriously underperforming. So everyone was taking the money away. So GMO's assets, don't hold me to the details, but you get the point. Went from, I think, 40 billion at the peak. They went down to, like, I don't know, 18 billion by year 2000. So they lost more than half their assets, even though they made money for their clients. Jeremy Grantham was prohibited from entering the investment office of the GM Pension Fund in New York City. They used to be at the GM building, 59th and 5th, where the Apple store is. He was prohibited from entering the GM pension office on the grounds he was deemed to be a dangerously persuasive person. A dangerously persuasive person. And he just wouldn't drink the Kool-Aid. So he got fired by a lot of managers. Chuck Clow, who was the global investment strategist, head strategist for Merrill Lynch, he got fired. Wouldn't buy the tech stocks. George Vanderheiden, the number 2 guy at Fidelity, fabulous fund manager. He basically got taken out of his job because he wouldn't buy the tech stocks. Julian Roberts had to close. Stan Druckenmiller went, long tech stocks, the 11th hour, then blew up. He had to close. I mean, this is what bubbles do to people. But anyway, here's the funny part. So, tech blows up. Grantham Mayo's assets go from 15 billion, I think, to 150 billion thereafter. Because for the next umpteen years, and O'Hare would know this, it was smooth sailing on the value stocks. So he's telling this story. This was like 2006 or 7. I remember I heard him at a conference. And this is great, Blake. This is why this is the relevancy of your question. So Jeremy sat on the board of some of the investment committees of the Boston hospitals, it was Children's Hospital or whatever. And they have managers come in, they want to get an allocation. And one of his go-to questions was, How much were you up in 1999? How much were you up in 1999? And if the answer was more than 15%, you would not be given any money. Because if it was more than 15%, it means you didn't know what the hell you're doing. You just took risk. And by the way, I'm triggered. I know I shouldn't do this, but I am going to do this because these people are just. Shea Ballor is another genius. Another one. I mean, you know what? Next one of these spaces, I'm going to put a tweet out of all the geniuses out there who just don't know what they're doing. And it's Dunning-Kruger on steroids. And they're all going to get nailed now. They are getting nailed. At any rate, Jeremy Grantham had the last laugh, but his point about not hiring someone because they were up too much. It's exactly what you're saying. Anyone who is stupid enough, and I say stupid, to buy MicroStrategy, as my friend said the other day, with MicroStrategy, Bitcoin, what is it? They changed the name to strategy, and soon they're going to be changing it to micro or something like that. I don't know. I mean, and then you got the wise guys coming. I just love these idiots on Twitter.
It's
Oh,
macro tragedy, George.
macro
Get with the
strategy. There you go.
program.
Macro strategy. Macro strategy. I love it better. So I posted a thing on MicroStrategy the other day, MicroStrategy, and it makes the example because Saylor was on the other day and they were interviewing him and now the stock's going down. They borrowed all this money in the preferreds and they don't come due, well, some of them until 27 and yada yada yada. So right here, right now, he's okay. But what happens when those things have to be refinanced? And you can he's already underwater on his Bitcoin, and I think at 8,000 is negative equity, whatever, it doesn't matter. So this genius writes, "Oh, do you really think Bitcoin can go to 8,000? That's unreasonable. That would be like asking Exxon, what if oil goes to $10?" The guy clearly doesn't understand what he's talking about. It doesn't have to go to 8,000, okay? If it goes to 50,000, 40,000, 30,000, the size of the hole in the balance sheet and his inability to refinance as Bitcoin goes down. Even now, if he had to refinance, I think it'd be a lot harder than it was when he originally borrowed the money. These people just have no idea, none, zero. And I'm all for, I'm getting a little bit hot here. I'm all for engaging in exchange of ideas. But when they don't know anything and they come with insults, I think boomer's an insult the way they use it. Okay. I'm like, are you effing kidding me? Anyway, they're going to get an education. The only question is, are they going to get it by precept, i.e., from reading a book, or are they going to get it real time, getting absolutely destroyed? And unfortunately, I think they're insisting on the latter. We're all human, so we all do it. All right, I'm getting tired now. Nasser, do you have anything else you want to say? Otherwise, I'm going to close this room.
Yeah, I was going to thank O'Hare for his comment about people going for the longer dated bonds. We're doing a bunch of projects right now where we've got long dated loans that people want to convert their operational capital or operational situation and convert it to any of the, rather than taking capital in a corporation, they're willing to take long dated debt up to 24 years, and trying to explain to people why someone would accept 24 years at 5% interest turned out to be a lot more difficult than I thought it would be. So when O'Hare says this was very small, but somebody's taking the long bond, it was like, I would really like to hear why why people would be willing to take a long-term debt or long-term bond in American currency in this particular environment right now, when that could add a variable to it. I'm confused as to why. I don't understand it, but I really appreciated O'Hare's comment because it's the first time I've heard somebody make
Well,
an
I think I
intelligent.
think I think to your point, it was I think it was the British sterling, I think pound sterling, denominated in that, not the U.S. dollar. But I don't think it matters. I mean, it was just a couple $1 billion. So
Yeah, and you know what's interesting too about O'Hare? We didn't get into it, but I don't want to mix things up. But if one is negative on the bond market, which I am, I mean, to me, well, I'm going to tell one story, and then we're going to close the room. And I want either O'Hare or Gnostic, you to respond to this. So I had a friend of mine the other day. He was being shown some annuity products, and he is in a position. He's got some money, but doesn't want to lose it, but also wants to participate in the market. So it's one. Here it's one of these collar jobs where there's a 6-year piece of paper. They give you exposure to the market. They're guaranteeing you're going to make 40% over 6 years, which is 6% a year, which is very low relative to history, but you could make the case maybe pretty high given the starting point of where markets are right now. In any event, they're saying, okay, Mr. O'Hare, we're going to guarantee you 40%. All right. The thing is, if the market goes up 41%, you don't get any more. You just get 40%. So if you reduce historical returns to say 10% a year for 6 years, compounded, that'd be like, I don't know, 70% return or something like that. You'd be leaving 30 on the table. And the way they guarantee the 40% also is they buy puts. They're basically selling calls to buy puts. So they're selling volatility to guarantee your return. And what they're doing is, and Joe Colasar is not in the room, but they're trading off the PTSD from post GFC, where everyone's afraid the market's going to go to zero. And they're saying, "Oh, Mr. O'Hare, you don't want to lose money, so we're going to guarantee you don't lose money." Like, yeah, I like that idea. I like that idea. But the amount of upside you have to give away to guarantee you don't lose money is atrocious.
That's the thing. They're selling the upside, but they're
Correct.
guaranteeing you the
Correct. Correct.
downside. Yeah.
Correct. Correct. Okay. So for the unsuspecting types, it's like, oh, that sounds okay. But then you think about it, it's a disaster. So it took me like 5 minutes to figure this out. When I realized what it was, I was like, are you effing kidding me? Hold on, Bitcoin. And the other thing, which is true with this, and I'm going to tie this into the comment just a minute ago about this long-term bond from Google, here, I think you and I have some reviews on bonds. God forbid bonds go down in price, yields go up. Either because of inflation, we got to print all this money, this, that, and everything else. It could well be the case that in nominal terms, stocks actually do quite well. Not in real terms, in nominal terms. So think about that for a second. If we jam everything up in nominal terms for all the reasons we know, with more money printing, giving away the upside. I mean, you're inflating everything up in American pesos. Selling the downside selling your upside to protect yourself against the downside. That's like the ultimate stupid idea. All right. In a similar way, buying a 100-year bond would be a really stupid idea. So to me, it doesn't prove anything. But I'm bearish on bonds anyway. I think yields are going up, not down. The only way it's not going to happen is if the bottom falls out of everything, we get a recession. But I think the they is in charge of doing everything they can to prevent that. And so more money printing, more they're going to have to print more money. They're going to run a responsible fiscal, yada yada yada. So yeah, we had this intermission for the gold market perhaps for a little bit, but this too shall pass. I think gold, they could easily double from here, but I'm not going to give a number. Silver, I think, will triple from here, but whatever. It's not. Please, for everyone at home, say, "Oh, no, bullshit." No, 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 no. If you look at the gold and silver stocks, if the metals prices just stay where they are, I think the gold stocks are going to double from here. God forbid if gold goes up, but I digress. In any event, coming back to this point about inflation and MicroStrategy and bonds in the Google bond, to me, it's just another tell that some schmuck would think a 100-year bond from Google is somehow unattractive, or somehow is attractive. To me, speaks volumes. It's a tell. Doesn't prove anything, but it's a
Well,
tell.
I think with this particular situation here with Google, this was very much oversubscribed. I don't think it was retail buying this. I think it was some hedge funds or somebody
Sure.
playing they're playing the yield curve here. So if they believe, if you're getting a 6.5% coupon and you believe the Fed's going to aggressively cut rates this year, you're actually going to make more, obviously, on this particular trade. They're not intending on holding this thing to maturity, George. You know this, so I think it's just more of a play on the
Sure.
yield curve than anything
Yeah,
else.
you know what? You're probably right. However, I'd say two things. Even if they're arguing against futures or whatever they're doing at the yield curve, two things. One, someone has to wind up owning that piece of paper. Okay, whether it's the hedge fund that bought it, or they're trading off the risk into something else. Just like when you look at the basis trade, the futures against the spot and the bonds. In the end, someone has to own the underlying instrument, right? So someone winds up taking that duration risk, whoever that is. Okay, whoever that person is, whoever that entity is, the fact that there will be an appetite for that, whether it doesn't have to be the original hedge fund that bought the piece of paper, is a tell in my view. And so we'll see. We'll see. I mean, this is just not normal. So anyway,
But
All right.
I do agree. I think we all agree, and I think especially you, and we've talked about this in spaces for a few months now. Whatever they do, they're going to push this. They're going to try to kick this can down the road. Remember,
Of
we
course.
are closing the government like every other week now. I mean, the reality is we're getting close to some type of an inflection point here. And gold, by the way, is the thing that's been sending the message all along, which many people have been, completely avoiding. So I agree with you. I think gold. This is just people think this is a parabolic move that's the blow off top and it's going down. I've heard people say it's going to 2,500, 1,500, just these ridiculous low level. I think it's going to a lot higher because of the things you just said.
100%, which is why when everyone says, what else you like besides gold and silver? I'm like, nothing else comes close. So no, it's yeah, no, totally agree, totally agree. All right, listen, we're gonna have to wrap this up. We're going on 2 hours. I hope you found this helpful. Brian was great. It was different. We'll do something again next Sunday at 11. I implore you guys, this conference, don't pass it up. You're gonna hear from 15 really smart guys, leading buy side guys running their own money, or really sharp independent research guys with stock picks, not bloviating macro talk. How to make money. $99, March 11. You can go to my feed, it's there. Also, take a look at my Substack if you want to do the paid something. It's great, but I've had this love hate relationship with X because too many clowns here, and also I'm tired of giving, giving, giving. I said, all right, so you know what? I'll continue to give, but if you want the really good stuff, it's only fair that you pay for it. So I'm not forcing anyone to pay for it, but everyone's got their choice. All right, guys, this has been great. Bitcoin, O'Hare, Gnostic, Blake, Brian's not here. We'll do it again next Sunday, same time, same station. Be well, guys. Take care. Bye.